Hello, you're welcome to FinInvest Niger. My name is Tom Princeville. I'm a certified securities and investment specialist, and I've been investing for the past 20 years. There's something I want to really highlight about investment strategies. These are man-made strategies that come with inherent pros and cons. And as much as we tend to highlight a particular strategy, we shouldn't forget the fact that the cons are also there. We need to talk about extensively so as not to be carried away by the pros and forget about the fact that the merits are equally there. In the course of this video, I want to talk about the pros and cons of dividend investing, the pros and cons of dividend investing. This particular strategy is all about investment for the primary purpose of receiving regular dividend income. So I want to highlight the merits, the advantages, or the cons of this strategy of investing. Number one here is regular income. It's a very important advantage of dividend investing, regular income. And this particular strategy provides steady cash flow from dividends. In other words, you receive your dividend regularly. It could be monthly, it could be quarterly, it might be semi-annually, and it might be annually, depending on the regularity the company chooses to adhere to. Number two here is lower volatility. You discover that dividend-paying stocks, they tend to be more stable than relatively more stable than other stocks in the markets. And so you want lower volatility. You don't want to be exposed to the high and lows of the markets. You go for dividend investing because it provides that relatively lower level of volatility. It sustains and provides stability in the markets. Number three is compounding benefits. You discover that reinvested dividend accelerates long-term growth. When you reinvest your dividend, instead of just spending it, keep on reinvesting it year in, year out, you discover that your portfolio will grow tremendously at the end of the day. And number four is inflation hedge. Dividend growth can outpace inflation over time. You know, generally, your growth in dividends year in, year out will end up outpacing the rate of inflation in any given environment. Number five here is quality signal. When we talk about quality signal, consistent dividends often indicates that the company has or possesses strong fundamentals, because generally companies with strong fundamentals tend to make an exceptionally high level of profits, and from these profits they are able to pay regular or constant dividends. So it indicates the fact that the company has strong fundamentals. Number six is downside cushion. We discover that a dividend kind of reduces reliance on capital gain, even if there's no, higher than normal capital gain. You could use your dividend income to cover up for that particular shortfall, and so there's that, reduced reliance on capital gains. Dividends alone can equally take care of you as an investor. Number seven is long-term focus. In this case, it tends to encourage discipline, patient investing, because you want to be able to be around to receive your dividends. You become the more disciplined. You don't just sell haphazardly. And you become more patient with the market and with the behavior of the stock in your portfolio, because at the end of the day, you are targeting the dividend these stocks will pay you at the end of the fiscal or the financial year. Number 8 is flexibility. There's that level of flexibility because income can be reinvested or used as cash. So there's flexibility there. You have income coming in, which you could choose to reinvest or you could choose to spend, as the case may be. So you're not really tied down to waiting until you are your portfolio appreciates. No, you can equally cover up or be taken care of by the inflow of dividend that comes in regularly from the stocks in your portfolio. Number 9 is tax efficiency. When it comes to tax efficiency, it is not in all markets. In some markets, that efficiency is more pronounced compared to some other markets. So favorable dividend tax treatment may apply. In other words, dividend could be taxed at a specific rate compared to other income somebody might earn. It could be that special consideration for dividends when it comes to taxation. Number 10 is psychological comfort. Psychological comfort. So in this case, income reduces emotional stress during market swing. When the market swings up and down, the normal market volatility, the fact that your dividend keeps coming in as expected will relieve the stress, the psychological stress you're being exposed to as a result of the market, swinging up and down. At least you are getting regular money coming in. So you'll not be as stressed up as compared to if nothing is coming in the form of dividends. These are the pros, the advantages, the merits of investing in dividend-bearing stocks. I want us to really fully consider this because this will really motivate us not to discard this strategy despite the disadvantages, the pros we are going to talk about in the later part of this video. So as I'm talking about the cons, disadvantages, please don't forget about the stress are equally placed on the advantages of this of this investment strategy. Now, the other one is the cons of dividend investing. I've spoken about the pros. I want to equally highlight the cons, which of course is equally, they are very, very important. Number 1 here is limited capital growth. Limited capital growth. So high dividend stocks usually may grow slowly. You don't grow as fast as other stocks other growth stocks that don't pay dividends. They grow slowly, probably, single or double digits returns per year. They are known to be slow growth companies. Number 2 is dividend cut risk. Dividend cut risk. In this case, payment can be reduced during market downturn. When the company underperforms for certain reasons, the dividend amount could be slashed. If they're paying, let's say 5% of earnings, they may end up paying maybe let's say 3% of earnings as dividends. So there's that particular risk that your dividends could be, for a particular year, could be lower than what was obtainable the year before. It's a particular risk we should bear at the back of our minds. Number 4 is sector concentration. Sector concentration. You discover that often some sectors tend to pay dividend more than some other sectors. Like the banking sectors in Nigeria here, they pay dividends regularly. And so because you are a dividend-minded investor, you may want to put virtually almost your entire capital on the banking sector. So in this case, you are becoming over-reliant, on the particular sector because you want to gain dividends from the stocks in that sector. That's a huge disadvantage of this particular strategy. Number 3 is yield, or rather, number 5 is taxation. So in the case of taxation, dividends may be taxed as income. It may or may not be, but usually it could be taxed as the way the way your salary, if you're a government worker, is being taxed. It might be taxed as your regular salary, your regular income. That's also a disadvantage. There may be no special treatment when it comes to the way your dividend is being taxed. Number 6 is interest rate sensitivity. There's that interest rate sensitivity. In this case, you discover that rising interest rate can pressure dividend stocks. Whenever there's a rising, interest rate, dividend stocks may become kind of, ignored, because in the other fixed income investing, you could get better returns than investment in dividend stocks. So in a case where there's a heightened interest rate, dividend paying stocks tend to be under, disregarded, tend to be, de-emphasized when it comes to investment, when it comes to choosing stocks. Number 7 here is Number 7 is opportunity cost. That's a very common term in economics. When you buy a particular item, you are buying it at the expense of some other item you call the alternative forgone. I'm trying to go back to my elementary economics. So in this case, you missed high growth stocks because you want to get dividends from dividend paying stocks. Some stocks, are known to grow at a very high rate, but unfortunately, they don't pay dividend. Because you are so mindful of receiving dividend, you might ignore them. You might refuse to buy those stocks and concentrate on dividend paying stocks. By so doing, you've missed opportunity you could get from investing in growth companies. Please like this video and subscribe to this channel, and don't forget to support me and help me to reach out to 1 million Nigerians with the investment message. And how will you do that? By merely sharing this video to other people in your community or your network. And number 8 here is a false sense of safety. There is this false sense of safety, and because dividends do not eliminate market risk. There's what is called market risk. Market risk, affects the overall market. Whether the stock pays dividends or not, it tends to affect the overall market. Like what happened during the COVID-19, almost the entire market was affected. Both the dividends and the non-dividend paying stocks, were equally affected as well. That's a typical example of market risk. And then number 9 here is inflation lag. Inflation lag means dividends may not increase as fast as inflation does. Dividends may not really catch up with inflation. So it is a risk we should have or bear at the back of our minds as individuals who may want to go into dividend stocks, who may want to adopt dividend investing strategies. So, the rate of dividends payment or increase may not be able to meet up with the rate of inflation in the economy. Number 10 is active monitoring needed. You need to actively monitor the market, because of the issue of sustainability. You must assess whether a company is able to or will sustain its dividend payments, in the future. So you actively monitor the market to seek for stocks and to invest in stocks that are likely to keep on paying dividends in the near future. You don't just fold your hands. No, you tend to get involved in active monitoring of the dividend paying stocks in your portfolios, and the ones that may not pay dividends, you just you liquidate those positions and concentrate more on the ones that pay dividends. So the cons here is that you are fully actively involved in monitoring your portfolios to make sure that the ones that are not that may find it difficult to keep on paying dividends, you kind of expunge them from your portfolio. Please don't go away. There are other videos as well in this channel that will help you to broaden your investment horizon as a beginner or even as an experienced investor in the market.